Okay, some issues on financial statements. Page S2 of your handouts talks about adjusting journal entries. There's both note disclosures of the ITCs and the expenses. So Canadian generally accepted accounting principles recommend that you illustrate the research expenses, you state the amount of research expenses that were claimed, and also the related investment tax credits. These accounting principles say that the tax credits should be shown as a cost reduction method. Typically what we recommend is that tax is a cost. So rather than reducing the cost of labor and materials and all the individual expenses of subcontractors that were claimed on an item-by-item basis, we recommend that you take the tax provision itself, show the recovery of taxes, really a negative tax provision, a recovery of income taxes, and put that all through. The reason for that on the tax return is multifold. One, it makes it easy for the Canada Revenue Agency to track how much of the ITCs are in there, because ultimately we want to add those back on our Schedule 1 reconciliation of financial statement income to taxable income. If we put it through the tax provision, Schedule 1 automatically adds back the tax provision, so the chance of missing this is mitigated. One of the other huge issues to contemplate in financial statement disclosure, in my professional opinion, is whether something's a research expense, i.e. we write it off as an expense in the current year, or whether at the end of the year the company has achieved what we call a development expense. And what generally accepted accounting principles say is if we meet 5 certain criteria, we do not expense those costs because we say it represents an asset, a future intellectual property asset to the company. So if I spend $1 million developing a particular machine, let's say, and I have not proven it technically feasible at the year end, I don't know if it's ever going to work, that would be a research expense. If instead I've proven that it works, and I've identified a market for this good, and I've met certain other criteria, what I'm supposed to do is show the shareholders of the financial statements that I actually have something called the development expense, that I actually have an asset here which is going to produce profits over a future period, just like a capital asset, just as a machine or a building or a vehicle might. So instead of expensing these on the income statement, what happens is we capitalize these as a cost, and we amortize those costs over the expected earning stream of the related product or process. If I say, well, I'm Microsoft and I developed this Windows operating system, which I think is going to allow me to make profits for the next 50 years by selling this to every computer user on the planet, I would take the cost to develop that system and maintain and further improve it, and I would amortize those costs not in the year that they're incurred, but over the expected earning stream of the related product or process. All right. Going to the bottom of page S7 of your course material, we give an example of the capitalization criteria and how they might be applied to a sample situation. So here we have widget 1 and widget 2 that were developed over a certain period. And for each of those, we're going to ask 5 questions. Number 1, are the products, is the product defined and the cost identified? We know exactly what we're building, and we know within a reasonable degree what the actual costs are going to be. So let's assume yes on both of those widgets. Number 2, is the technical feasibility established? Are there huge technical problems which need to be overcome in order to get this to market? And if so, we would say no. But let's assume that we've got all the technology problems resolved, which is usually the biggest issue from an SR&ED standpoint. Number 3, do we actually intend to bring that to market? So management's expressed an intent that we want to bring this to market. We'll assume yes on those, or probably we wouldn't be doing it. Number 4, is the future market is clearly identified? This is where we get a large degree of judgment. If the goal on my financial statements is I don't want to capitalize and amortize this because it creates capital tax implications or any other reasons, what I could say is, well, maybe I can't predict the economic life, or my market's too competitive, and therefore I can't clearly identify it. Again, one of the big problems of this position is that often in a public company particularly, the management discussion and analysis may provide contradictory information to this. So again, really what we want to do is try to get the truth, or as close to the truth as we can find based on the facts, and say, is the market clearly identified? And as importantly, I would say here, can we predict the economic life of the asset? Because that's going to determine whether we amortize it over a month, due to huge technological obsolescence, or maybe 20 years if we've got patent protection or something of that nature, or maybe something more or less. Okay? And the fifth is basically that we have adequate resources to bring it to market. And again, that becomes very judgmental on what does that mean as far as distribution channels, barriers to entry, things along that nature. So if we assume we can answer yes to all of those questions, what the Canadian generally accepted accounting principles will say is we should capitalize and amortize those costs over the expected earnings stream of that product or process in order to inform the financial statement users that we didn't waste their money on research in the year. We actually developed something that we think gives them a reasonable chance of successfully at least recovering the costs that were incurred to do that development and perhaps providing additional profit on the flip side. If we flip to the next page, S9, we give an example here of how we might capitalize those costs at the end of the taxation year where we did answer all 5 of those questions yes. So on one of our widget examples, we answered yes at the end of 2008 and 2009, and perhaps on another one we've done work over the prior years without answering yes to all 5 questions until 2009, in which case you would only take the latest numbers. So at the end of each taxation year, you ask these 5 questions. If in 2009 we answer yes on widget 2 to all 5 questions, that does not mean we go back and restate the cost for 08 prior. We only start now from 09 forward to capitalize and amortize those costs. In this example, what we have is a 5-year life roughly, or a 20% amortization rate. And again, we would disclose in the financial statement notes of the company how we picked that and ultimately why that's a reasonable period for the amortization.